So this is a project where we're excited about all these projects, but this is incredibly exciting because this is unlocking the intraday repo market. Just to do some introductions, Scott, I know you're on the platform this morning, but maybe you can just briefly give us an introduction and then talk about a little bit about the blockchain deposit account. Yeah.
Yeah, sure. Thank you. I was up this morning. I work at JP Morgan. I've been there for about 13 years, and I sit in our markets business and look across trading products on DLT. But before that, I think this stuff is kind of more my background, as I used to sit in our Chief Investment Office Treasury unit and ran intra-liquidity across the firm for my last job before this one. And so I have a vested interest in exploring this a little bit further because we think there's some real risk transfer, risk reduction, and sort of commercial opportunities in the intraday space, particularly, as I mentioned this morning, as we look towards implementation of GSIB calculations on a daily basis and how we might think about changes in funding, simple things like T+1 settlement in the United States for equities and what that means for funding from further east, et cetera. So there's a lot of opportunity in this space. Part of that, in this particular context, is taking something that we've done already for a couple of years bilaterally with our clients, and we'll continue to extend the footprint of that. And partnering with HQLAx, who's got a wider set of available collateral through their network, and bringing those things together with Ownera. So, part of the challenge, I think, generally for the market is the accessibility of cash on ledger. It's something that, HQLAx is working towards, accessing that. This is one of those solutions. It just so happens at the moment we have a proven blockchain deposit account capability to provide cash on ledger to settle securities transactions. We expect to see more of that, but for right now, we think it's a good opportunity to demonstrate wider set of collateral from HQLAx, interoperability from Ownera, and looking at the way we would achieve that as a financing trade on our platform using cash at JP Morgan. Still bilateral to our clients, but with a sort of an expanding network, which is, I think, important for the development of this technology in the market.
Very good, thank you. And Guido, we met a little while back, actually, because Guido was the visionary who realized early on around the potential, people thinking about tokenizing assets, distributing them, buying and selling them. But Guido understood the importance of collateralization and what this meant potentially for the mobilization of collateral. Before we get into the details of this intraday repo project, I think because many of the people in the room maybe don't swim in the world of securities finance so much, I think it'd be really interesting just take a few minutes to talk about HQLAx, what you do, and what this all means for the world of securities finance.
Sure, Anthony. Thank you very much for referring to me as a visionary. That's quite nice. I think with the vision also comes a real sense of persistence, I have to say. So I started this company along with co-founder Ali Bankert back in 2017, so we've been at this for quite some time. Prior to co-founding the company, I was at UBS for a number of years, over 18 years, mostly in secured funding functions, sec lending, repo, collateral management, et cetera. And it was at UBS where I was in a group treasury function responsible for firm-wide secured funding, and it became very apparent to me how complex it is for a group treasury function to efficiently manage a balance sheet across a number of different legal entities, across time zones, et cetera. Managing collateral in Europe is particularly challenging because the underlying security settlement system is very, very fragmented, where you have a number of siloed security settlement service providers. So managing a balance sheet within Europe is quite challenging. And I ended up reaching out to a company called R3. So David Rudder is a personal friend of mine. I worked with him in a previous lifetime. He had just launched a company called R3, which at the time was a consortium of 9 banks, I believe, looking to solve for solutions using blockchain technology. I literally knew nothing about the technology at the time. But I knew about the pain point of the security settlement system, specifically as it relates to securities finance. So I reached out to David and asked him whether I could, come and pitch. I should back up. I explained the pain point to him, and he then invited me to come in to pitch to a number of clients around creating a proof of concept. And I know we're moving away from proof of concepts, but this is back in 2017. But by the way, proof of concepts in 2024 and beyond are no longer proof of concepts or POCs. They are production on chain. Okay, so I'm going to, as a visionary, I'm kind of going to rename POC to production on chain. But anyway, to make a long story short, we ended up creating this company called HQLAx. We ended up organizing a really impressive, I think, set of strategic investors, including JP Morgan, and Scott Lucas, by the way, is also on our board. Our strategic investors also include Goldman Sachs, Deutsche Börse, Bank of New York Mellon, BNP, and Citi. We have a growing list, actually, of strategic investors. I can't quite announce this yet, but there'll be some nice additions to our cap table and to our board going forward. And I think a really key point here is that the technology that we are all using in this space is groundbreaking, but to take the technology forward and for it to be useful in day-to-day practice, you need a network of people and institutions within those people to move initiatives like HQLAx forward. So the technology is groundbreaking, as I mentioned, and incredibly important, without a doubt. But it takes more than technology. It takes people to move projects and companies over the line. One really key point in the very beginning of our journey was we received feedback from our initial set of clients and investors that in order for HQLAx to be successful, first of all, it needed to demonstrate to clients and investors the economic reality that using this technology and creating this operating model would in fact create shareholder value for the clients, that there would be economic value to be derived, that it wasn't a sky in the pie concept that maybe could work. No, this was the initial design was very much based on very specific capital cost savings that our initial clients and investors could really put their hands around and understand. And then very importantly also, the path to going into production could not be one that required a bank to go through a full change the bank initiative, because integrating these systems, putting them into use, if it requires a bank to fundamentally change the way that they're interacting with the market today, then it would be quite challenging to get market adoption off the ground. So the approach that HQLAx have taken is to leverage this new technology, but complement it with existing piping that our clients are using, and complement it also to work within existing legal constructs and regulations so that we're not reinventing the wheel. In terms of products that HQLAx are live with, we launched the platform with a securities lending product, which enables banks to execute securities lending transactions in a more capital efficient way. We are now developing some margin products to enable both sell-side but also potentially some buy-side clients to manage their variation margin more effectively. Would love to get some money fund units on there, so we should talk more about that. And then Repo. Repo is also a fundamental product that we are moving forward with. Our collaboration with Ownera, JP Morgan, and Wematch is an example of that. But maybe just quickly, just to put some numbers to the discussion here, because I think numbers are important because they drive economic value. If we just look at the addressable market of collateral management across those three trade types that I just mentioned, securities lending, margining, and repo, they are absolutely staggering. So at the end of last year, there were a total of 24 trillion of collateral obligations that the securities finance industry had to meet. Now, the securities finance industry is comprised of global banks and asset managers, but it's safe to say that 80% of that 24 trillion is being managed by the top 50 institutions active in this space. So we're not talking about having to reach out to 1 million clients. We're talking about a very targeted set of clients to the tune of 50. The breakdown of those collateral obligations is as follows: 2.5 trillion of securities lending, another 2.5 trillion of margining, and then 19 trillion of repo. So the 19 trillion part really highlights the fact that repo is just a really, really very important integral part of securities finance. And that 19 trillion actually doesn't even include, to my knowledge, intraday volumes. And once we get platforms like ours connected with JP Morgan's intraday platform and others, this intraday repo market is really going to take off, and I think it's really exciting times ahead. Maybe lastly, just one quick thing in my opening words here. Sorry if I'm hogging the stage. Apologies for that. But at the drinks last night, Lord Hammond made a really interesting remark regarding windows of opportunity. In this case, he was referring to the window of opportunity of the UK establishing itself as the go-to digital finance space in the world. I think there's also a window of opportunity on a professional level for many folks sitting in this room. So we talk about using this technology. It's there to be used now. HQLAx is in production. JP Morgan is in production. There are other platforms that are live, okay? So if you're in this room, do what you can to understand the pain points of your company and how this new technology and these new platforms can help, because the window of opportunity could be closing in on enabling you to be the hero within your institution to connect the dots between pain points that your institution is feeling and leveraging this new technology, because it's there to be used. You don't want to be asleep at the switch, so use it and, just use it, I guess, is my key message.
Thank you, Guido. It's perfect. And Guido wasn't hogging the stage. I actually asked him beforehand to go into a little bit of detail because I thought it would really interest the audience to tune into this space of securities finance and the potential to collateralize high-quality liquid assets and also, in due course, collateralize high-quality illiquid assets, which then become more liquid. Just very briefly, we ran a video and there was a lot to take in. Just to summarize quickly what you saw on the video. So you've got Guido that's got this amazing platform that has digital collateral records. Records of collateral held by the big CSDs in Europe. And Guido can do DVD between securities to securities within that platform. JP Morgan have a leading digital cash platform with JPM Coin with a blockchain deposit account. So we have collateral and we have cash. There's another fantastic fintech, couldn't join us on stage today, Wematch. Wematch provide matching software to trade floors for various financial products, Repo being one of the many. So you all get talking, and the video says collaboration through the spirit of industry-wide collaboration. Yeah. That's what it's all about, because to do this heavy lift of the industry, no one entity is going to do it on their own. So we came along, and maybe we had the missing piece with FinP2P. So basically, Ownera commercially build routers to the FinP2P spec. So we basically sell FinP2P routers to HQLAx, sell FinP2P routers to JP Morgan, sell them to Wematch. What that enables the platform to do is Wematch have basically the buy-side router, so repo traders can come to that platform through the interface you saw briefly on the video, and then they can select to do this intraday repo between collateral and cash. And then those routers peer-to-peer orchestrate the repo transaction. The upshot of all of that is the repo traders can negotiate their repo trades with settlement at maturity time specified to the minute. And I guess it means that you can then start charging accrued interest by the minute rather than overnight. So that's a summary of how this works. Scott, for you, maybe you can just expand a bit on what we've been doing the last year, because tech's one thing, but getting this into production with a tier one institution is a completely different ballgame, right?
It is, and an apology to the engineers here, but none of these are laws of physics that we're trying to work around, and if you put the ones and zeros in the right order, the engineering problem will be solved. And I feel there's enough smart people working on the technology to solve almost any challenge that we throw at them. But if you want clients to take risk, and you want them to sort of trust the platform they're taking risk on, have confidence in the legal structures at which they can take that risk, they also need to have confidence in all the phases of those technologies and how they work. And like all technologies, at some point they'll break. So when it does break, where does the liability sit? And that's complex. It's really complex when you've got core components that are existing technology, even if they're new, like HQLAx, even if they're new, like our Repo platform or the Intra-day Repo platform we have today. But then you add another layer of complexity. That's difficult to then onboard, understand the sort of provision of the service, agree some service terms, and then stitch those things together. So I think the core component of where we need to get to is not just adding the sort of technology components together. That's great. That enables the exercise. Not just recognizing the pain points of like, this is what we want to do, and we can see the money. And the first question we ask ourselves on any of this stuff these days is like, if we're going to do it, where's the money? Where's the P&L going to be? How do the clients get value out of that? How do we generate that value, and who gets paid for it? And so once we've identified both those ends of the spectrum, the hard work starts. And that's where the legal, regulatory, and sort of combination of those two things fit together. And again, because there's subjectivity around those, and because there's a risk appetite involved in those, that's some of the work that we need to work on. And this project is still in project phase. We're still targeting a go live sometime through 24. I fully expect that we'll achieve that. But like with any of these things, there's kind of risk around like what hurdles do we run into? And in the deployment of our Repo project, like we found areas in specific prudential regulations in Europe that limit that particular country from doing something the same as the country next door, even though Europe has a consistent, broader regulation. HQLAx had some challenges around the initial model they were given, because when you get into the bowels of that, when it applies to sort of some of the other areas about asset segregation, you've got to revisit that model. So they're the sorts of things that, engineering is one thing, money is the other, getting that piece of how it fits together in a construct that, and this is the key point, people will put real money on the table to take risk. That's the area we've got to focus on. And I have absolute confidence we'll get there, but it's tough.
Very good. Yeah, so this project... So this project's been running for over a year, right? And the thing we did first was roll our sleeves up and put the tech in POC. So it's actually beginning of this year. We were guilty. We did a press release for all of this, if you have a look online. That was the POC, right? We approved the technology back in January, February. So what we've been doing all of this year on the tech side is actually operationalizing it, if that's a word, hardening it, taking it to production. But then probably even more resources being focused on the legal and reg, right? You've got all of the, as Scott says, the liabilities and responsibilities of the entities involved in this platform. You've also got new products. So if there's any fintechs out there that doesn't know what an institutional new product committee is, I recommend you learn, because if you're going to sell to institutions, they have to go through these processes with 13 departments internally to get approvals for stuff. And then after you've done all of that, you have to go to the regulators, right, and get their approval as well. So just to get under the hood of this project, I can tell you the technology is about done. In fact, we're very close to doing all the production releases for the technology, but that's production releasing the technology, isn't production releasing the business platform, right? So you've got legal, regulators, etc. And to Scott's point, that's what will bring us to market in 24. So we're starting to promote this initiative with the securities finance industry, because we feel that institutions that want to come on board and join us will probably be a race. We'll probably beat them to production before they can join the platform, right? So we're starting to promote this across the industry. So I don't know which one of you wants to take this. I know Scott's running out of time. Just the benefits of this. So we've talked about, wow, intraday repo, to the minute, settlement, maturity time, blah, blah, blah. Why? So what does it actually give the capital markets industry?
So I guess the key thing there is really, when you look at kind of the other sources of liquidity today, you can have deposits at your bank, you can have inflows that you receive from payments that into your account, you can have a unsecured, uncommitted credit facility. But since about 2015, 2016, in most jurisdictions, certainly in the United States and Europe, there's been a requirement to have an intraday liquidity stress buffer, which takes into account the reliability and availability of those sources. And quite naturally, if you have deposits and you can sustain those for a period of time, you can rely on those. You can rely a little less on the sort of inflow of the payments, but by nature, having an unsecured, uncommitted credit facility, you can't rely on that. And so if you can't rely on it, then you've got to hold whether you call it pre-funding or a stress buffer or something or other, typically treasuries or some other G10 or even G5 govy that you can monetize today in order to meet that obligation if the liquidity is not there for you. That's got an opportunity cost associated with it, somewhere between, depending on the stress framework, like 45 and 70 basis points, on the other alternatives you could do with that cash rather than invested in treasuries and all of that purpose. And that could be wider, depending on the market condition. However, if you have a secured source of funding and you can demonstrate that availability through time, and over time, as a market develops, you can identify, you can demonstrate the diverse availability of that from different sources. You don't need the stress buffer because actually people will take risk against an idiosyncratic sort of situation in stress if you can do a secured financing trade. The price might change, there'll be a few other dynamics, but you can still probably rely on the liquidity if you've demonstrated availability over a period of time. If the cost of that, somewhere south of 45 to 70 basis points, is cheaper than holding the treasuries and gives you more availability, you can use collateral that actually you don't necessarily have any other purpose for. The economic incentive is clear from a client perspective. The risk footprint is clear from a client and from a provider perspective. And actually the broader market is more secure anyway. So, it's fine doing it bilaterally. There's absolutely economics in it for us, for our clients. There's a risk differential in it for the broader, for us and our clients. But if you can think about it as a market structure, which is why we'd like to bring HQLAx in to then have a wider set of collateral available to our clients, then eventually a wider market structure, there's real value in that. And I go back to the point I've made a couple of times already, particularly when you think about where the market's going from a cost of liquidity and capital versus overnight trades, whatever you can move intraday, where the opportunities to do that, and it won't be everything, but there'll be some, there's real money in that and there's real value in that. So that's kind of the purpose of the trade. So it's not about an experiment, it's about value and economics using things that are already live in the market.
Yeah. So if we're beyond POCs, we're probably also beyond use cases. So what we're focusing on with all of these are business cases, right? I know we're close on time with Scott's train, so I'm going to let Guido maybe. So what does this tell? Now we've gone live with all of this, and now you've got digital cash that you can exchange real time for your digital collateral. Where do you take it from there? What does this mean then going forwards for you and the industry?
Yeah, so first of all, our future vision certainly entails repo, intraday repo, but also securities lending and margining. Our focus really is on enabling the industry to manage collateral more efficiently. So when you look at those 24 trillion of collateral obligations, institutions that have to manage collateral to satisfy those obligations will typically have those securities sitting in a number of different depositories. And our vision and our plan moving forward is to collaborate with other service providers in the collateral management industry to enable a bank to readily manage its collateral obligations via an optimization engine that determines how best an obligation should be met, whether it's on ledger or off ledger. So that's the future vision. But I did just want to say one more thing about Project Prince. And so, sorry, the name of the project that we were in together is called Project Prince.
Highly confidential.
Okay.
Yeah, no.
And the origin behind the name is as follows. It's actually dedicated to a chapter of a political treatise that Niccolo Machiavelli wrote in the 16th century. And this chapter is dedicated to discussing change and innovation. And here's one of my favorite quotes from that chapter. "There's nothing more difficult to take in hand, more perilous to conduct, or more uncertain in its success than to take the lead in the introduction of a new order of things. For the innovator has enemies in all those who profit by the old order, and only lukewarm defenders in all those who would profit by the new order. This lukewarmness arising partly from fear of their adversaries, and partly from the incredulity of mankind, who do not truly believe in anything until they have had actual experience of it." So in my opinion, this quote really does exemplify the trials and tribulations of actors of change, of folks leading innovation, and it really underscores the fact also that collaboration is key. There is no one platform that's going to bring in all the business. Platforms need to collaborate with other industry platforms to be successful and to provide industry solutions. And Project Prince, which is a collaboration between Ownera, HQLAx, JP Morgan, and Wematch, is an excellent example of that.
A perfect way to finish a panel. Thank you, Guido. We'll let Scott run for his train.
All right.
Thank you.